Well, as young Canadians spend increasing amounts of time on social media, we're hearing more and more about mental health worries. Dove is one beauty brand shining a spotlight on the issue as part of a new marketing campaign. It's a raw and powerful choice for a campaign, and it's gone viral. We spoke with Dove's chief marketing officer about what led to the launch of this campaign.
Dove, has a long history of building body confidence and self-esteem in young people since almost 20 years, actually 19 years when we started the Dove self-esteem program. And basically, recently we did a study. We usually do research year after year and about what are the threats to young people body confidence. And we found that 88% of Canadian kids are exposed to toxic beauty content on social media. They declare to be exposed to that. 88%. And this content is negatively impacting the mental health of more actually than half of the Canadian kids. And actually then we discussed this study with youth mental experts, and there is an overwhelming agreement that actually we are talking about a mental health crisis. So we said, okay, we need to create awareness of this because, people know that maybe there is an issue, but they are not that aware of the scale and the depth of the issue. And that was basically the intent of the campaign. And the campaign, as you have seen, is a real story of a girl called Mary. And we leverage all real images from her life, actually from her feed. And it's a girl that, of course, suffered from mental health and, of course, was impacted by social media. There are also other girls that participated to the campaign. They are all in recovery, of course. But that's why the film has received so much feedback in terms of how touching it is.
It truly is impactful, and obviously when you begin campaigns like this with a strong message behind them, you're anticipating some of that feedback. But just compared to past projects you've been involved with, how impactful do you think this one has been?
I think so far has been extremely impactful because it doesn't talk only about the scale of the issue, but through a real story, really talks about the depth of it. And the depth in the sense of, what people go through since you start to get a phone, since you start to get in social media, what you see, you start to lose a little bit your innocence, your confidence, your body confidence. And then it can take you into dark places. And I think not everybody is aware of the depth and of the scale of the issue, as I was saying.
This campaign, in many ways, is about some of the harmful impacts of social media. Do you think it's important, especially at this stage in the evolution of social media, for more brands to be getting involved with this conversation, starting more of a conversation around this?
Yeah, I think it is important because, like with anything, social media can be a force of good, of self-expression, of creativity. But there are areas where there can be danger, like harmful content or like the digital distortion in social media. Just to give you an idea, 80% of kids by the age of 13 have already distorted their image several times on social media, which is impressive. And we know that when you retouch your own image consistently, you have proven a negative effect on your body image. So, there are a lot of areas where there are improvements needed. And of course, the more companies, the more brands join, the better. And that was also the intent of the campaign, to ensure that with the awareness, people take action and require a bit more intervention and recognize that this is a mental health crisis.
So given the feedback you've already received, has it emboldened you to keep the conversation going, to find other ways to deepen this conversation? Again, because to your earlier point, we don't necessarily always dive as deeply into this subject, maybe because we're not aware of it. I mean, I'm a parent myself, and you can't necessarily see what your kids are seeing on social media, but this very clearly lays out what some young Canadians are going through.
Yes, exactly. Yeah, definitely the conversation needs to continue. Our approach has always been, our intent as a brand is to make beauty a source of happiness and not a source of anxiety. And so basically the way we work, our whole approach, strategic approach, is to look at what are the sources of anxiety out there. That's why we continue to do research. And of course, whilst in the past, thinking about 20 years ago, the main challenges were on the lack of representation and diversity in media and advertising. And so basically we campaigned in that area with the Campaign for Beauty, you probably recall. Now, definitely social media are an area where, as I said, whilst they can be a force of good, but there are a lot of sources of anxiety that is important for people to be aware.
Now, we are also a business channel. Given the approach you took with this campaign and with some others over the years, do you think there is a new philosophy or a new way of thinking that is needed when it comes to the message? Because this is not just about selling product. This is aligning yourselves with issues that matter to you as a business.
Yeah, look, for me, you also are a business analyst. For me, one of my personal belief is that brands, especially brands and companies of a big scale, have the scale and have also the responsibility also to have a positive impact on society. The strategy, the approach of Dove is to ensure that we can have a positive impact on society, but at the same time, actually we make this also an opportunity actually to grow the business. And I think one thing that we are proud on this brand is to be able to combine the two things, to ensure that we have a positive impact on society, but at the end also we leverage the goodwill that we get from the good things that we do in order actually to have a faster kind of business development. So combining, proving that actually there is no trade-off between profit and purpose is actually extremely important for society, because it would be great more businesses actually adopt this approach.
Thanks so much for joining us on Morning Markets. On the desk with me now for the next half hour is Mark McQueen. He's the former president and CEO at Wellington Financial. Thanks for being with us.
Good morning.
You are a tech guy sometimes, you're a bank guy sometimes. You are not retired right now.
I'm on a break. I'm on the
beach. You're on a break, you're on a pause, if we can call it that. But I would like to talk to you about tech because, I don't know, my instinct is to see this as a problem. The concentration that we're seeing, the multiples that some of these stocks are trading at. What's your view? What's your instinct?
It's hard to follow what's driving it. So I think you're right on that. If you and I are still waiting for blockchain to change the world, and that's been a few years now, then this AI frenzy, this is like 2.0 AI, right? It wasn't that long ago VCs were putting $500 million into an AI company because there's 400 smart people that were going to change the world. And those businesses wound up going bankrupt, right? This feels, I saw a stat that 7 companies are accounting for all of the upswing in the S&P 500, Microsoft, Apple, NVIDIA. Where are the earnings from AI in the next quarter or the next 2 quarters or year? And they're not there, right? So you're right. It is ahead of itself. Amazon's up only 10% since Feb 2020. Same for Shopify. I would have thought now, given everyone's comfort with online shopping and whatever, that those stocks should be higher than the pre-COVID, given our change in behaviors. And it's not there. So the layoffs happened in big tech for sure, but if that's what's driving the earnings, that's temporary.
I guess in some ways, I feel like we have seen the script before. To your point, we get excited about a technology, what it could deliver, whether or not it will show up in earnings kind of remains a question mark. And then the other thing, I guess, is a cult of personality. Now in the CEO of NVIDIA, who I've been reading is being chased down the streets of Taiwan as a celebrity. He's a semiconductor CEO.
Yeah, well, and it was GameStop, I think, only last year or whatever, right? So you're right. It is, it's a phase for sure. Whether that business is worth $1 trillion, I don't know, but what I do know is that there's nothing going on in AI today that's different than machine learning a few months or years ago, and it's just a different excuse.
I guess the difference is
momentum
that
players are driving it because the algos are driving it. The momentum players jump on it, and so it goes up. Right, that's what's happening.
I guess it's that now everybody knows about it and can access it. You know, machine learning technology was something you really had to pay up for or be an engineer to understand. And now,
but if that's the case, then why does that company do better than others if everybody has access, right? In theory, democratizing technology should make it harder for big tech to get a premium.
That's true, but that hasn't happened in previous cycles, right? Like with Facebook, it was kind of democratizing media and all the benefits kind of accrued to them.
Look, if you believe that one big company will win, Google and Microsoft being examples of that, I think you're Twitter, perhaps, right, in the social media landscape, perhaps that's right compared to Snapchat. That certainly would be true, perhaps. But look, this is just a phase, and you're right. The fact that it's so concentrated that every other stock is flat this year, but those 7 in the S&P 500, that's disconcerting.
Well,
and the recession hasn't even come yet,
That's right, if it shows up. Maybe ChatGPT can tell us that. One of the things I think about, though, is like maybe the AI play is there, but it's in those sectors that haven't participated in the rally, that have really thin margins, that have a high number of employees, that are most likely to benefit from the productivity gains. I mean, at the end of the day, this is kind of what is so great about AI, is that it will lead to productivity.
Well, at the banks, which of course so many Canadians are invested in through pension plans or directly or mutual funds, bots should be reducing workload, right? And if you are having cost growth problems at big, Sun Life or Manulife or the Royal Bank, bots should be, which AI, of course, different way of describing it, should be solving that, right? Paper-based processes that can be automated. I mean, that's a multi-year process that maybe this will accelerate, but it won't be the next quarter.
This should be an area where Canada is dominating. The roots of OpenAI are very Canadian. And are you seeing that, putting your VC hat on, are you seeing Canadian companies kind of lead the charge, understanding that OpenAI is like the big game in town and has those Canadian roots? Isn't here,
Look,
but
the Montreal VC crowd has certainly tried to make to harness that intellect. CDL, the Creative Destruction Lab here at U of T in Toronto, is a probably global leader for drawing talent and VCs to meet that talent for business plan ideas long before revenue. So I think we have the right kind of framework for it, but the companies aren't there in droves. Certainly not a way that's going to create billion-dollar companies today.
So the companies are not there. It's not a situation of the dollars aren't there.
There are angel and Series A VC investors in the United States flying up to Toronto every quarter to meet business plans in the machine learning and AI space. So that is happening. We don't have a capital problem. We have a conversion of IP to commercialization to then jobs.
Well, the business of YouTube is a massive one. The unit of Alphabet generated more than $6.5 billion US in revenue in the most recent quarter. And YouTube is also sharing some numbers on its size and scale here in Canada. It says its creative ecosystem contributed more than $2 billion to the Canadian economy last year. Tara Walpert-Levy is Vice President of the Americas with YouTube, and she joins us here in studio. Thanks very much for your time.
Oh, thanks for having me. It's great to be in Canada.
So we like to talk about our numbers. That $2 billion figure, like what goes into that? What is that comprised of?
Sure. I mean, we were really excited. Our partners, Oxford Economics, are the ones who measure it, and it makes up a couple things. One is what you'd imagine, basically direct revenue that creators are making off of our platform. And so we have 10 different ways they can make money. It's mostly ads and some direct from consumer. And then there's a whole segment of the indirect revenue, which is these creators hire teams, their businesses, they rent studios, they rent equipment, and they also find other opportunities based on building their brand, like brand deals or speaking opportunities. And so it really all rolls up into the $2 billion contribution to Canada.
And sometimes I see there's like integrations with other platforms out there or other players out there to help to, I guess, monetize beyond what you can do with advertisers.
Exactly. And some of that would be in sort of that latter bucket, right? These brand deals or sponsorships that all come from, the 35,000 jobs in Canada that are created by this creator economy.
I've been covering this business long enough to know there was a time when we talked about the creator economy or what that might be. Now it is very much alive and well. But in terms of the success rate, right? Like there's a lot of people who now they want to grow up and be a YouTube star. how challenging is that when it comes down to it?
Well, it's funny. I mean, one of the things that we are most focused on is making sure that our platform is the absolute best for creators, both creatively, including getting started, financially in terms of being able to build a brand and business doing what you love, and also emotionally in that sort of connection with audiences and fans. And so, we get told all the time by our creators, no one is saying it's easy. It's a career. It's a livelihood like everything else. But we have removed a lot of the obstacles that prevented people from launching content and having a voice. And that's really what our mission is all about, is to enable that diversity and that range of stories.
And YouTube does get credit for leaning into that creator possibility earlier than arguably most did. I would imagine if you're talking to creators or partners or advertisers, they also ask about the broader social media landscape. You got players like TikTok out there as well. So in terms of those new ways that you're sort of leaning into making it even a more creator-friendly environment, is it challenging when you've got other players who want part of that pie as well?
Well, I mean, listen, YouTube has always played in a very competitive space.
Yeah.
And so I think what's been unique from the very start is some of the unparalleled breadth and diversity of the content on the platform. That's why we're so focused on remaining, what many creators tell us is their home. And so I think as long as we keep working and earning our spot in their hearts and their minds and their pocketbooks every day, we'll continue to be the best space for creators and advertisers and viewers. And frankly, a little additional competition only makes us up our game.
Now, we've spoken with members of the Alphabet executive team as well about some changes to laws in Ottawa. Bill C-11 is one that people talk a lot about, the idea of, and it's obviously not just a Google or YouTube thing. It's, how do we make sure that Canadian content is rising to the top, and that it's a level playing field with traditional broadcasters as well. How are you navigating through some of those changes that have been taking effect?
Well, it's frankly fascinating. I think one of the biggest changes we saw, and that's true here and around the world, is really seeing the creator voice in the legislative process. So I'm sure you've seen how these folks are out there talking extensively, both during sort of the legislation phase and now during the consultative phase. And our goal is to continue to support them. These laws affect their livelihood and their businesses in really material ways. And so we're just trying to sort of help make sure that everyone sort of understands as clearly as possible what's possible and try to create opportunities that work for everyone, and including these creators.
Speaking of understanding, everybody's talking about artificial intelligence as well. I know your parent company is all in on AI, but I wonder what you think about. Like, is AI something that plays into the story of being a creator tool? Is there also a conversation around how AI changes the content itself?
Well, YouTube and Google have been AI first for a long time, right? So there's a lot of ways that we have historically used AI for recommendations and other things that help these creators build their businesses. And we think there's a lot of ways that folks can use it as creative prompts, right? And we went to many of our creators early, as we launched Bard, and sort of got their feedback on what would help them with everything from idea generation to ways of making creative more efficient, to different ways that they can play creatively. So we think it's a pretty big opportunity.
And so how for the size and scale that you already have, and we cited that $2 billion figure, can you give us a sense on how much you are growing at this point in a country like Canada as well? Yeah,
I mean, look, we continue to see a lot of runway in Canada, both sort of in the Canadian market, and also your creators do an amazing job exporting their content. 90% of the views for many of these folks is happening outside of Canada. So it's an incredible opportunity for Canadian creators and culture builders to extend the reach around the world, and we think there's a lot more to go there.
Okay, Tara, thanks for your time today. Appreciate it.
Thanks so much for having me.
Well, Lululemon shares are jumping after the athletic apparel retailer beat street estimates on both sales and adjusted profit. The Canadian company also boosted its annual guidance on a stronger than expected first quarter. For an analyst take, let's bring in Zachary Waring, equity research analyst for CFRA. Zachary, quite the reaction in after hours. The stock really popping there. What is jumping out to you the most with these results?
Yeah, thanks for having me, Jacqueline. So obviously, first and foremost, I think international was pretty impressive, 60% growth. They commented on China and how strong China was in the quarter. That's the first thing. Secondly, inventory is still a little elevated, but I think investors are looking through that because of the growth.
So the inventory levels, so up 24% from a year ago. Last quarter had been a 50% year over year gain. What would be more of a normal level for Lululemon?
Yeah, so, with our estimates, we're looking somewhere between 1.3 and 1.4 by the end of the year, which we think is manageable for them. And we think, management team there isn't really worried about it. Obviously, when you have strong sales growth, you can get rid of inventory pretty quickly. So I think investors are looking past that at this point. The first 2 quarters of last year and towards the end of the last year, investors took notice. Obviously, when you saw 50, 75% increases in inventory, it's a pretty big deal. But I think now they're looking past it.
Margins were a touch above estimates as well. I understand you think that Lululemon can, have its margins hold up a bit better than some other retailers?
Yeah, so obviously you saw the 360 basis point improvement in the quarter for gross margin, which was led by freight expenses is what they state, which we expected. Now that we've seen almost all apparel companies, report this quarter, we've seen that across the board. It's been mentioned multiple times. And we think Lulu obviously caters to a higher income consumer. When you're selling, yoga pants for $120, $150 a pop, you're typically targeting a higher income consumer. So, we think in a downturn, they'll do just fine. And they obviously have plenty of runway for international growth, which you've seen in the quarter.
Freight expenses, you just mean, transportation costs, like fuel costs and that kind of thing were more favorable for Lulu?
Exactly. So almost all apparel companies have stated this quarter, which they're seeing year over year decreases in freight costs, so shipping costs, basically. And so that's been a big thing, a big theme this quarter in retail.
And you mentioned China a couple of times. Going forward, how big of a role do you think China is going to end up playing for Lulu?
Yeah, their management team is pretty excited about China. It's kind of first and foremost for international growth. Last year, they ended with 117 stores in China, and they opened up 31 new stores in China last year. So they're opening a lot of stores there. They opened up 81 stores total last year across the globe. So their focus is on China. That's where they opened the most stores last year, and they've talked about it in recent quarters. So I think that's their main driver for international growth. They want to quadruple international sales by 2026, which after this quarter, I think they're pretty much well on their way.
There have been a lot of, questions about Lululemon's mirror business. That's the a fitness mirror that essentially has classes playing in it, and people can do the classes along with looking through the mirror. However, Bloomberg was reporting that the company's looking to potentially sell the mirror. What do you see the future holding for the mirror for Lululemon? I feel like that's like a mirror on the wall kind of thing, and I didn't mean to, but where do you see the mirror going for Lululemon?
Yeah, so management has basically said multiple times that it's probably not going to be a big driver of revenue growth. They stated that 2 or 3 quarters into the pandemic when they bought it. Obviously those kind of sales were surging for Peloton and Mirror. But yeah, I don't know what they'll do with it. It's definitely not a big factor in their overall strategy, though. It's more just targeted towards maybe their stores where they can have it in their stores. And, if they sell a mirror, great. But, I don't think at this point it's a big push forward for them.
Now, beyond Lulu, you also cover a couple of other retailers that we've been focused on in, today and yesterday. Nordstrom is another one of them, and it kind of ties to Lululemon in the sense of that higher-end customer, although Nordstrom was pointing to its more discount rack stores as seeing some strength in this latest quarter.
Yeah, so the consumers, we like both sides of the consumer. So we like the high-end consumer, and then we also like off-brand discount. Anything in between, we want to stay away from in this period, just because there's so much uncertainty. Nordstrom, I upgraded yesterday to a hold from a sell. It had declined 40% over the past few months. So I raised my opinion there. We don't like them that much. They're not well run, not a great balance sheet. So, they're just one of those companies for us that, we're neutral on it. We were negative for quite a bit for about a year and a half there, but.
And what about Macy's? Because it dialed back its expectations going forward. What are you thinking about Macy's? Is that more of that in the middle kind of retailer that you're steering away from, or how would you quantify that?
Yeah, so we think Macy's is being a little conservative with guidance, and we think that's probably the right move. You've kind of started to see some slowdown in some of these other retailers report that, the consumer's starting to be impacted by, no stimulus, higher interest rates. Macy's is one of those it's a well-run company. They've got a clean balance sheet, but at this point in time, there's a lot of, negative tailwinds or headwinds facing the company. Obviously, they're mall-based department store compared to, some of the other ones that have, like Kohl's has a smaller mall presence. We're neutral on Kohl's, but we like their long-term strategy a little bit better. And we actually have a buy rating on Dillard's just because we think they're operating just as good as you can for a mall, a department store retailer. They buy back a ton of shares. They've bought back 50% of their outstanding shares over the past few years. So we like them just from a cash flow and capital returns perspective.
Okay. Zachary, great to get your reaction to Lululemon with all the reaction that we're seeing in the after-hours trade as well, and on those other two. Thanks so much for your time today.
Thank you.
That was Zachary Waring, equity research analyst for CFRA.
Welcome back. It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back with another segment with Bill Harris of Avenue Investment Management to talk about, Bill, the commodities market, something you've been watching for a long, long time. We've seen commodities under pressure this year. The common narrative is that commodity market investors are worried about slowing economic growth and a possible global recession. So we're seeing oil under pressure, copper under pressure, uranium you'll speak about as well. You think that there are opportunities developing here?
So first of all, it's the financialization of everything. We've seen that, with low interest rates over 20 years, how it's the money in the market really moves things. And so a story like that comes on, and maybe China's not as strong growth as you would expect. And so in which case, the money energy last year was the only place to be. Now you're watching that money. It's got to come out of energy because all this other stuff in the stock market is moving.
Like those tech stocks.
Right. So then coming into saying, well, what is the supply-demand fundamentals in oil, and just pick copper, the two big ones. And there's still actually, the story is still there. It's a really tight market. And so you can, again, the anomaly of watching this happen and saying, okay, so how are the stocks doing versus the commodities? You can make that story and understand why the commodity prices are coming off, but that longer-term oil story really is intact. There is not a lot of incremental oil. I like this other idea that if you're saying the U.S. running down the strategic oil reserve, because there's an idea that they just don't need it. Why do we need oil in 10 years' time? Except the actual fact of how much oil we're using on the planet, 100 million barrels a day, is still there. China is still now back to what it was pre-COVID, and the strong supply and demand. Copper, on that side, there still just isn't any copper out there. So if we're going to get to this world, we still need these things. So this is actually quite nice as an investor, because as the commodities come off, the stocks come off, we know we've actually got a great fundamental story long term. We can now spend the summer going through the businesses again, saying, we've got a core holdings, and we will be looking at those to add if we get good prices.
So you speak about the financialization of these commodities. In other words, many investors are traders, and they're buying and sell copper and oil contracts, not on fundamental supply and demand, but on
rate of return.
Correct.
My money's got to make money,
right,
and it's not making in copper this month.
However,
so I'll go over here as fast as I can, and then I'll come right back. Oh, when the copper story's on, well, I can just sell this and come back to this.
However, your view is sooner or later the fundamentals come home to roost, and that higher commodity prices will flow out of simple supply and demand. Correct.
So even if you have a lower, like a North American manufacturing consumer recession, it might not actually affect the overall supply and demand dynamics in the commodity on a global basis. And this is the thing, there just isn't that much supply. We cut off the increasing supply of oil and copper. Again, there's just no mines being produced. So at some point, even this base load demand that we have globally catches up with how much raw commodity is out there.
Okay, and what about uranium? You wanted to talk about uranium as well, and I think we've got a couple of ETF graphs that show an index of uranium mining stocks and the metal itself.
So just as we're coming into summer, everything kind of quiets down a bit. You've got the earnings season off. Yes, we've got these big macro pieces we're looking at, but debt ceiling, unemployment. But just staring at the screen, watching again, in this case, the commodities coming off, it was very interesting to see uranium actually just ticking up. And we've been watching uranium, talking about it for years now. It got to 50, which makes sense. But then from 50, it's now ticked up to 55 in a really quiet market. When everything else was going down, it really seems like an anomaly. And so, and when we're saying, again, money wants to go somewhere, it has a great long-term fundamental story, but when does it kick in? You can sit there for a long time. We originally played Cameco. Cameco's now gotten expensive. We are in Denison. And it's just really interesting to watch that happen this week. Why it happened, I don't know, but it did happen.
We could take a quick look at Cameco, that's CCO on the TSX. It hit its highest price in many, many years yesterday. I believe this is more than a 10-year high on Cameco. There's a 3-month view. We could take, if it's possible to take a longer view, like a 10-year view. There's a 5-year view. Anyway, Cameco, you get the picture. Cameco's trading at a multi-year high. Bill Harris, thank you a great deal for joining us. Bill Harris is partner and portfolio manager at Avenue Investment Management and our featured guest of the morning.